So, very warm welcome to all on this fourth session of technical analysis. And in this fourth session of technical analysis, we are going to continue with our candlestick chart types. Okay. So, if you recall what we had done in the previous sessions, we started off with understanding of when can we consider a candlestick as bullish and when we will take a candlestick as bearish in nature. So a quick reflection on that. So if you see in case of bullish sentiment, we usually get to see a white or a green candlestick. And why we refer to it as bullish? Because the closing price is over and above the opening price. Okay. And this is the real body which we discussed. This is the lowest price of the day and this is the highest price of the day. So since the closing price is over and above the opening price, it indicates a bullish sentiment. And this is a bullish candle. And on this, these are the two wicks. The one on top is referred to as the upper wick, and the one below this is referred to as the lower. And this is referred to as the day's range, that is the difference between the highest price of the day and the lowest price of the day. So let's say the highest price of the day is 1000 and the lowest price of the day is 800, which means that the day's range has been 200 points for that particular day. So this ensures that the market for that day has been bullish in nature. And that you can very well read by looking at the color of the candlestick. It can either be white, it can be green, okay? And if it is red or if it is black, okay, then it indicates a bearish sentiment. So in bearish sentiment, the closing price is well below the opening prices, right? The closing prices is well below the opening prices, which means that it is the seller's market that day and the market sentiments are going more on the negative side. So this is the highest price for the day, which has been reached with reference to that particular stock or any kind of asset class. And this is the lowest price of the day. But how will you identify that this is a bearish sentiment? In that case, you have to look essentially at the opening prices and the closing prices. And the closing prices will be below the opening price for that particular day. And this is the day's range as to what was the highest price and what was the lowest price. Right? So today we will be taking few more candlestick chart types, which will help us to understand that what is going to be the market likely in the very next day or in the near future. So the first one which we are going to take up today is the shooting star. Now if you look at the shooting star, this is how it looks. So this is an picture of a shooting star, right? And as you can see, a shooting star, it indicates a bearish sentiment. So how will you identify a shooting star? So as you can see in this particular picture, it is characterized by a small real body. And why small real body? Because you see that the difference between the opening price and the closing price is comparatively less. But the closing price is below the opening prices, which indicates that the market for that particular day is bearish. So essentially it is indicating a bearish reversal may likely to happen. So the real body, as you can see, is at the bottom or at the low of the end of the day's range, okay? And it is a very small or a no lower shadow, either a no lower shadow or a very small lower shadow. Okay? And the long upper shadow, as you can see, it's quite long and it should be at least twice the height of the real body to actually understand that it is the case of a shooting star. Now the color of the real body is not that important, and shooting star, it appears at the uptrending market. Okay? So a shooting star occurs after an advance and indicates the price would start falling. Now, the formation of a bearish, shooting star, or the formation of a bearish sentiment, because the price tried to rise significantly during the day, indicating a buying pressure. So here, the prices had gone considerably up, indicating a buying pressure, okay, which was seen over maybe the last several periods. But then the sellers, they took over and pushed the prices back down towards the open. Okay? So as the day progresses, though the sellers step in and push the price back down to the near open, erasing the gains of the day. Now this shows that the buyers lost control by the close of the day and the sellers may be taking. So the moment you get this kind of an indication that the sellers are taking over, it is but understood that the reversal is likely to. So the long upper shadow represents the buyers who bought during the day but are now in a losing position because the prices dropped back to the day's low. So the traders typically wait to see what the next candle or what is going to be the candle like in the forthcoming trading session, okay, which will help to understand that whether it is following or what is following a shooting star. So if the price declines during the next period, they may sell or short, which means it is a confirmation thereby that from here on the markets is going to move downwards. And that is wherein the next period you will see that there is a downtrend which is happening, and the market participants may sell or they may short by looking at these kind of an indication. So if the price rise after a shooting star, now this is something interesting. If the price rises after a shooting star, the formation may have been a false signal, or the candle is marking a potential resistance area around the price range of the candle. So you have to be very careful as to what is happening in the next trading session, whether the price is still declining or whether it is going up after the shooting star. So if it is going up or if the price rises after a shooting star, the formation of the shooting star may be a false signal, or the candle is marking the potential resistance area around the price candle, around the price range of the candle. Now, as you can see in this particular chart, you see a shooting star. Just see how a shooting star looks. So this is how a shooting star looks. Okay, a small real body at the bottom. Okay, and the upper shadow, which is at least twice the height of the real body. So in this chart, this is exactly what you get to see. A shooting star, the real body at the bottom. The long shadow is almost twice, more than twice the real body. Okay, and this is happening in an uptrending market. This kind of a shooting star you get to see in an uptrending market. And the moment you see this in an uptrending market, followed by a negative sentiment in the very next trading session, it is indicative of the fact that from there on, the market is going to fall down. And that is what we get to see from this particular chart. So the price was rising, the trend was an uptrend, and then we witnessed a shooting star. Okay, and shooting star, as you can see, the real bottom, the real body is very small, and it is towards the lower end. Okay, and very near to the lower wick. Okay, and you also get to witness a long upper shadow, which is almost twice or 2.5 times the real body, and that is wherein you get to sense that yes, this is a shooting star, and very likely if it is happening in the upward trend, it either indicates that a reversal, a trend reversal is likely to happen, which means a bearish market trend is likely going to follow. However, if the very next day, if it is not bearish, then it indicates that the market is more towards the resistance. Okay, and that was the shooting star was a false signal. But nevertheless, you can understand that it indicated a resistance existing at that point in. Okay, so as you can see over here in this particular chart, the uptrend accelerates just prior to the formation of a shooting star, and the shooting star shows the price opened. It opened and went higher, then closed near the open. Okay, and the following day closed lower. As you can see, the following day it closed lower, helping to confirm a potential price move towards the lower side. The high of the shooting star, as you can see, the high of the shooting star was not exceeded, and the price moved within a downtrend for the next. See, so if trading this pattern, the trader could sell any long position they were in once the confirmation candle. You can see the confirmation candle. So once the confirmation candle was in place, the trader could sell any long position, because after that, most likely that a reversal will follow and the prices will start. So this was a shooting star candlestick. Next we come to hammer. So yes, why a hammer? Because as you can see, the real body in this case is at the top. That is why it looks like a hammer, and that is why the name of this candlestick is hammer. Okay, and what you see over here is the real body in this case is also small. Okay? And the real body is, unlike the shooting star, the real body is at the top of the day's range, and it has a very small or absolutely no upper shadow. However, you witness a long lower shadow, which is at least twice or 2.5 times the height of the real body. So you see height of the real. Now the color of the real body is not that important, and if you see the hammers, they occur after a price decline. So the hammer candlestick shows a seller came into the market during the period. They pulled down the prices. Okay, all right. But however, the buyers had pushed the price back to the near. So the close can be above or below the open. Although the close should be near the open in order for the real body to be small. Okay. Now the hammer candlestick indicates a potential price reversal to the upside. So prices are moving up after we witness the hammer candlestick pattern. Okay, so it indicates a reversal, and it happens once when the price is going down. You witness a hammer, and then from there on, you will see that after you witness this hammer, you see what is the market sentiment in the very next day, and if it is a little bit bullish, then it indicates that the price reversal will be towards the upside. Okay, so the price must start moving up following the hammer, and this will confirm that yes, the reversal on the upside is going to happen. So if you look at this particular chart, okay, you can see the hammer over here. You see this hammer? The real body is at the top of the, of the, of the upper wick, okay, and the real body is also very small. Look at the lower shadow. So it appeared that the sellers, they were dominating the market, but eventually it is the buyers who came back and pulled the prices up. Okay, so the chart type shows a price decline followed by a hammer pattern. Okay, and this pattern had a long lower shadow, several times longer than the real body, as you can see, and the hammer signaled a possible price reversal to the upside. So a declining market, okay, a downtrending market, we witnessed a hammer. Okay, so this confirmation came from the next candle that yes, the price is moving on the other side. So from downside, after you witness this hammer and you looked at this candle on the very next day, the confirmation of price reversal to upside is very much to be witnessed going right. And that is what you get to see, that from here on, the reversal is more towards upside after you have witnessed the So during the confirmation candle, which is this, is when traders typically step into buy. So you have to. So if you ever happen to see a hammer, look at the candlestick type, the immediate after that particular trading day, and if it is green in color, if it is bullish in color, it confirms the price reversal towards upside, and that is the time for the buyers to enter. So a stop loss is placed below the low of the hammer, or even potentially just below the hammer's real body if the price is moving aggressively higher during the confirmation. So these are the kind of traits which you should look for, and accordingly have your own position by looking at all these candlestick chart. So this was about hammer. You can see more examples of hammer over here. So as you can see, the hammer indicates a potential upside. You see a hammer? Okay. Okay, there's small real body at the top. Okay. And since it is to be seen at a declining phase, it indicates that from here on, the market is going to go. From here on, the market is going to go on the higher side. Okay, so if you are witnessing this, and on the very next day, if you witness a white candlestick or a bullish candlestick, that is a green candlestick, it kind of confirms that yes, from here on, the market is going to go, and then you can go for taking a long position, right? Again, you get to see over here a hammer after downtrend, and from here on, if you see the prices, it goes again a hammer, and from here on you see the prices are going up. Again a hammer, and then you see from here on the prices are going on the higher side. Okay, so hammer essentially indicates a reversal trend, and the trend is more towards upside. Okay, so it indicates a bullish trend which is likely to happen. Now, what is the difference between a shooting star and a hammer? Right? They all have small bodies, okay, small real bodies. They all have long shadows. Okay, so a long shadow on a long upper shadow in case of a shooting star, and a long lower shadow in case of a hammer. So it looks very much identical except for the placing of the real body, or where the real body is positioned. Okay, so the shooting star and the inverted hammer, they look exactly the same. They both have long shadows, as you can see, and they also have small real bodies. So what is the difference? The difference is in context. So a shooting star occurs after a price advance and marks a potential turning point which is on the lower side. Okay, so it will indicate that a downtrend will occur. Okay, the moment you witness a shooting star. And in case of hammer, okay, an inverted hammer occurs after a price decline and marks potential turning point higher, which means after you witness a hammer, obviously it indicates that the market from there on is going to move. So these are very important kind of candlestick chart types which will help you to form your own positions, okay? But nevertheless, be very careful as to what is going to be the candlestick which will take place in the next trading session, because that acts as a kind of confirmation as to which direction the market is. If, however, you get to see no specific candlestick, okay, the signs are not very clear, then it's better to refrain yourself from entering into the market, because that candlestick is not showcasing any kind of. So be very clear about this as to what is going to be the candlestick after the shooting star or after the hammer, okay, which is witnessed, right? Okay. Next we come to difference. So next we come to, after having done the difference between shooting star and hammer, we now come to our next candlestick chart type, which is hanging man. Why hanging man? Because as you can see, so it's of course, since you have done hammer, hammer and a hanging man, they look very much similar, but of course there is a difference. We will look into the difference in a while. So hammer, a hanging man, if you see, it's again referring to a bearish reversal. Okay? So it again has a small real body like the hammer. Real body is at the top end of the base range. So just to take you through the hammer. So this was a hammer, okay, and yes. So again, the hanging man very much looks like a hammer, okay, and you witness a small or a no upper shadow, a small or a no upper shadow. Whereas if you look at the lower shadow, you witness a long lower shadow, which should at least be twice the height of the real body. And again, in this case, also the color of the real body is insignificant. And in this case, the market is in uptrend. So in a hanging man is a bearish reversal candlestick pattern that occurs after a price advance. Remember, a hanging man is a bearish reversal candlestick pattern that occurs after a price advance. And the advance can be small or large, but should be composed of at least a few price bars moving higher overall. The close of the hanging man can be above or below open, and it just needs to be near the open so as to have a small real. Now the lower shadow, the long lower shadow of the hanging man shows again that the sellers were able to take control for part of the trading period. And hanging man pattern is just a warning. Okay? And the price must move lower on the next candle in order for the hanging man to be a valid reversal pattern, and this will be indicating a confirmation. So traders typically exit long trades or enter short trades during or after the confirmation of candle not movement. That is also advisable to you as a trader, that wait for the confirmation. Only once when you get the confirmation, after you see this hanging man, you see what is going to be the candlestick chart pattern the very next day, and accordingly you exit long trades or you enter the short trades after the confirmation is made by the candle in the next session or in the following session. So this is an example, a chart type reflecting a hanging man. Okay, and this is also what again differentiates between a hanging man and a hammer. So in hammer, what happens? By now you must have understood that in a hammer, it is the hammer takes place at the lower end, okay, whereas a hanging man is seen at the upper part, upper part of the of the price movement, so to say. So coming back to this chart again, and we'll again go back to the differentiation between hanging man and hammer. All right. So this chart type, as you can see, it shows a price decline followed by a short-term rise in prices, where a hanging man candle forms, right? Okay. So following the hanging man, as you can see, the price drops on the next candle, providing the confirmation needed to complete the pattern. Okay, so it is at this point, what will you do as a trader? You will exit the long trades and you will enter into the short trades. Okay, the moment you get this kind of confirmation. Now, during and after the confirmation, the candle traders would enter the short trades, because now it's very much confirmed that the trend reversal is likely to happen, or it has already started. Okay, and it's better to take the short trades and exit the long trades. So the example in this case, it highlights that the hanging man doesn't need to come after a prolonged advance. So do you see any prolonged advance, any prolonged rise in price? Okay. So rather it can potentially mark the end of a very short-term rally within a longer term downtrend. So you have to be very careful where it is positioned. Okay. Now, this is again an example of hanging man. So you see this hanging man. Yes, let's see this again. real body at the top, and then you see what happens. There is a price reversal, a downtrend is to be seen. Here also a downtrend to be seen. You see a downtrend after the hanging, and this is more so confirmed. So this is a hanging man which you get to see. Okay, and then after that, the next candle is kind of confirming the bearish sentiment. Okay, and since this hanging man is happening at the very, at the uptrending market, so to say, you see that it's kind of an uptrending market. And since this hanging man chart type is witnessed after an uptrending market, immediately you see what is the candlestick after that. Okay, and if it is bearish, then it is a confirmation that from here on the reversal is definitely to step in, and accordingly you will be going for the short trades, because from here on the prices are going to move further. So this is kind of a forecast which you can do. All right. So shooting star, hammer, hanging man, they are, and of course, if it is confirmed, then it is understood that a reversal is going to happen. And accordingly, you are required to take your positions, long or short, whatever the case may be. Looking at the chart type, whether you witness a shooting star or a hammer or a hanging man. Now, uh, difference between hammer and a hanging man. So this is a hammer, as you can see. This is again a hanging man, almost very similar, absolutely similar, you can say. Right, but both of these, they indicate a trend reversal. The only difference between the two is the nature of the trend in which they appear. So if the pattern appears, if this kind of a pattern, if it appears in a downward trend indicating a bullish reversal, it is a, so the prices are going to go up. So if I can take you to that hammer again, this is how a hammer. So this is what. After a hammer is witnessed, the prices are going to go up. Okay, but after a hanging man is witnessed, the prices are going to come. Okay, so if the pattern appears in a downward trend indicating a bullish reversal, it is a hammer, and if the pattern appears in a chart with an upward trend indicating a bearish reversal, it is called the hanging. Right? So the difference between a hammer and a hanging man. So in a hanging man, it's most likely that there will be a reversal, which is going to be downward in nature, whereas in case of an hammer, it's going to be on the upward side, which means it's going to be a bullish reversal. So I hope now the difference between hammer and hanging man is absolutely clear, right? Okay. Next, we move to the difference between shooting star and a shooting star is like this. So, of course, there is a difference in the formation of the real body. So, in shooting star, as you can see, the formation of the real body is towards the bottom, and in case of hanging man, it is towards the upper way, closer to the upper, on the top side, high side. Now, both of them again they indicate a trend reversal. The hanging man and shooting stars, they appear near the top of an uptrend. However, the difference is that the small real body of a hanging candlestick, and it has a long lower shadow. Whereas in case of a shooting star, it has a small real body near the bottom of the candlestick with a long upper shadow. But both of them, they indicate a reversal, and the reversal is more towards the, as you can see, hanging man. Let me just take you through. So it's more towards the downward side, right? So shooting star has a small real body near the bottom of the candlestick with a long upper shadow, as you can see. And primarily, a shooting star is a hanging man which is flipped upside down, as you can see. Now, in both the cases, the shadows should at least be 2 times the height of the real body. And these candlestick chart types, they indicate a potential slide lower in price, which means the moment you witness either a shooting star or a hanging man, there is going to be a price reversal, and it is going to be on the downward side. Okay? So the prices will move down from there. As you can see here, the prices will move down if you witness a hanging man or if you witness a shooting star. In either of the case, the prices are going to move. Okay? So the only difference is in terms of the real body, but essentially both of them indicate that from there on, the prices are going to come. Right? Okay. Next, we start with another chart type, which is your bearish engulfing candlestick. Okay. Bearish engulfing candlestick. So the bearish, it is also referring to a bearish reverse. Now here you can see, so far we were seeing only one candlestick. But now in this case, you see two candlesticks. Right. So you see in this case that there are two candlesticks side by side. Alright. And a bearish engulfing pattern is a technical chart pattern that signals lower prices to come. Why lower prices to come? Because immediately after this white real body, you get to see a very big, long real body which kind of engulfs, okay, the small white real body. Okay, so the moment you get to see this kind of a chart pattern, okay, it indicates that from there on there is going to be a reversal, and the reversal is going to be on the downward side, which means it is going to be a bearish reversal. So the pattern consists of an up candlestick, or so to say a white or a green candlestick, followed by a large black or red candlestick, as you can see, okay, that eclipses or engulfs the small candles. So do you see this? This black real body kind of engulfs or eats up, okay, or eclipses the white real body. Okay? And this pattern can be important because it shows sellers have overtaken the buyers and are pushing the price more aggressively down. Then the buyers were able to push it up. Okay, so it kind of confirms that from here on, if you get to see these two candlesticks one after the other, it is kind of an assurance or a confirmation that from here on, the bearish sentiment is likely to be more stronger, and a bearish reversal is likely to happen. So the real body, if you look at the real body, the difference between the open and close price of the candlestick is what the real body or the down candle must engulf the up candle. Now the pattern has far less significance in case of a choppy market, which means the market is going up, going down, up and down, up and down. So in that case, this kind of a bearish engulfing candlestick, it hardly signifies anything because the markets are choppy. So you really don't know what is the mood of the market, what are the sentiments of the market. And thereby, the pattern has got greater reliability when the open price, okay, when the open price of the engulfing candle, okay, is well above the close of the first candle. So the open price, just have a look at this, the open price of the engulfing candle is well above the closing price, is well above the closing price of the first candle. Okay, and when the close of the engulfing candle, as you can see, the close of the engulfing candle is well below the open of the first candle, it indicates a bearish engulfing candlestick for sure, and that a bearish reversal is going to. Now, a much larger down candle, so the higher the real body, it strengthens the fact that from here on there is likely going to be a bearish reversal, and from there on the prices are going to move down. Okay, so a much larger down candle shows more strength than if the down candle is only slightly larger than the up. Okay. So this was about the bearish engulfing candlestick, and let's see a bearish engulfing patterns, right? So in this chart, you get to see three bearish engulfing patterns. But the most significant engulfing pattern is out over here. So do you see this? Do you see this? One is green, white body or green body, and the other one immediately after that is a very big real body, a red real body, which indicates a bearish market And if you see, the real body is far more longer and bigger than the previous day's green candlestick, indicating a bearish sentiment. And look at its opening price and look at the closing price of the bearish candle. And from there on, so this kind of signifies that from here on, a bearish reversal is likely to happen. So you see the immediate day after that, look at the opening price and the closing price. And from there on, look at the way the prices have moved. Okay. Now coming to the next one, if you see, okay, so it does indicate a bearish engulfing candle, but on the very next day, if you see, there is no significant kind of a change which is being witnessed in the market as compared to this, okay, right? So you have to be very careful that what is the candlestick immediately after that, because that kind of confirms as to what is going to be the situation like in the forthcoming trading days. Okay? So if it is not very clear as to what kind of situation is likely going to happen in the near future, because the candlestick is not very prominent in this case, as you can see, the bearish engulfing pattern is not very prominent. Why? Because the very next day it's not giving a very strong signal as to which direction the market is. Okay? And then you see again this pattern, right? And then from there on the market moves up. So it's not very evident, it's not very clear, okay, that what is the impact of this bearish engulfing candlestick the very next day. So since it's not very clear, it's better to refrain yourself. Okay, and it indicates a choppy market. So these two, as you can see, this bearish engulfing candlestick, and again over here, you see this, again a bearish engulfing candlestick. So these two bearish engulfing candlestick, they are less significant since they occur during choppy trading and not after a price as in this case. Right? So here more emphasis, more importance should be given to this bearish engulfing pattern rather than these two. Okay? Why? Because they occur during choppy trading and not after a price. So you have to be very, very careful when that pattern is to be seen. And accordingly, you will strategize. It is very important in while you are using, the chart types for your decision. Okay. So this is again a case of a bearish engulfing, and here you see it's very, very prominent. The market is then moving down. You see the real body as compared to the previous day's real body, which was white. Okay, and this is kind of eclipsing the previous day's candlestick. Okay? And from there on, you can see the very next day. Look at the candlestick; it closed much below. It opened also below. Okay, the previous candlestick, which was more of engulfing candlestick, which confirms that from here on a price reversal is likely to happen and the market is going to move downwards. So this is strengthening. This candlestick, what you can see after this engulfing candlestick, is kind of confirming, okay, or assuring that from here on a price reversal is going to happen and it is going to be a bearish reversal. So you have to be very careful about the confirmation. Okay, right? Again, bearish engulfing. This one is again confirming. Again, a price movement. Price is going further down. So from here again, look at this. So here again, just have a look at this. Price is going down. Price is going down. After this engulfing, you see the price is going. Just look at the very next day's candlestick. Further down, look at the lower lows. So the sellers are contributing in a big way in the market. The sellers are ruling the market, and from there on, you get to see that the prices are moving forward. Right? So this is a bearish engulfing. Some more chart types of bearish engulfing. Look at this. You witness this. Okay, again, the very next day, look at the candlestick. Okay, look at its close, look at its open, and from there on, it started. And if you look from here to here, the pattern was more of a down trend. And you can take a conscious decision of taking a short position. Why? Because from here on, if you look at the trend, if you look at all these confirmation, it is understood that a bearish reversal will be taking place. And accordingly, you take your position. So you exit all your long position and enter into the short position after looking at this bearish engulfing candlestick, right? And maybe you wait for a very a support level from wherein you can start taking a long position. So if you look at this chart, okay, if it is this kind of at this point in time, maybe you can look forward to enter the. But for that also, you have to wait for some kind of a trigger. So maybe after this, if you get to see after 2 or 3 sessions on a continuous basis, a white candlestick or a green candlestick, which is showing higher highs, okay, and a higher lows, then it will be indicative that from here on, you can start taking the long position. Okay, so this is how you are going to use all these candlesticks for your decision making. But here essentially we were trying to understand the bearish engulfing, and that is what you get to see a bearish engulfing candlestick pattern, and from there on the prices are moving significantly. Okay. Next we come to the bullish engulfing candlestick. Okay. So the bullish engulfing candlestick, it represents a bullish reverse. So if it is down from, and if you witness this bullish engulfing, from here on, the prices are going to go. Is a small body, small real body, okay, and a white body, which is, so if you see this white body in this case, so it's exactly opposite the bearish engulfing candlestick. Here, a white body or a green body is kind of eclipsing the small real body. Okay. Okay. And what you get to see in this case, the closing price is higher the opening price. Look at the lowest price for the day. Look at the highest price of the day. Look at the previous day's lowest price. Look at this day's lowest price. Look at the previous day's higher price. Look at the current day's highest price. Look at its closing price. So here for a small body, I mean, since it is black or red in color, whatever, since it is indicating a bearish candlestick, so the closing price is going to be over here for this particular chart candlestick, and the opening price will be over here. So since the closing is less than the opening, of course, it indicates a bearish candlestick. But look, immediately after this, what kind of candlestick you witness? You witness a bullish candlestick, which is kind of eclipsing or engulfing this bearish candlestick. And why so? Because look at the range of the prices and look at the positioning of the closing price and the opening price. So if you get to see this kind of a candlestick back to back, one which is bearish in nature, having a smaller body, small real body, and the very next trading day, if you get to see a bullish candlestick, which is kind of engulfing the previous days or the previous sessions candle, which was bearish in nature, it is indicative of the fact that from here on, the bullish reversal is likely to happen. And this is the time wherein you can start taking a long position, because the markets from here on are going to be okay. So the bullish engulfing pattern is a 2 candle reversal pattern. Second candle, as I said, it completely engulfs the real body of the first one without regard to the length of the tail shows. The bullish engulfing pattern, it appears in a downtrend and is a combination of one dark candle followed by a larger hollow candle, or so to say a green candle, okay, or a white candle. And on the second day of the pattern, the price opens lower than the previous low, yet buying pressure pushes the price up to a higher level than the previous high. Which means what? The buyers are kind of ruling the market. So culminating is an obvious win for the buyers. Okay, since the prices are going up, it is a win. It indicates that the buyers are settling in the market in a big way, and it is advisable to enter a long position once when you happen to see a bullish engulfing candlestick. Okay, and so when the prices moves higher than the high of the second engulfing candle, okay, in other words, when the downtrend reversal is confirmed, it's better to go for a long position. So a bullish engulfing pattern can be identified when a small black candlestick showing a bearish trend is followed by a large white candlestick the very next day showing a reversal, showing a bullish trend, and the body of which completely overlaps or engulfs the body of the previous day's candlestick. So understand that this bullish engulfing candlestick, in order to make the decision more strong, okay, it should happen in a downtrend. This pattern should be witnessed in a downtrend market. And the moment you get to see in a downtrend market this kind of a bullish engulfing pattern, immediately you will find a bullish reversal. So this is a bullish engulfing candlestick, and the moment you get to see, look at the reversal and the prices, it goes up from there on. You see this. After this bullish engulfing candle, okay, after this bearish candle, look at how the prices are moving. So it kind of indicates a bullish reversal, right? Now, let's come to dark cloud cover. A dark cloud cover is again signals a very strong impact in the market, and it essentially indicates a bearish reversal. So what you can see over here is the highest price. You have to actually see the three candles back to back, right? And in the very first candle, you can see the highest price of the day, the closing price, the opening price, and a large white candlestick, and of course the lowest price one. Okay, so it is indicating an upward in the market. But the very next day, what is it you see? A black candlestick or a red candlestick, indicating a bearish. And the very next trading day or trading session, you see another black candlestick whose real body is very small. So the opening price and the closing price are somewhat very close to each other. And look at the lowest price of this candlestick. It is slightly low. Look at the highest price of this particular bearish candle. It is much below than the previous day's bearish candle highest price. You see the significant difference in the highest price of the previous day, okay, and the highest price of that third trading session. And look at the body, the size of the real body. It is much smaller. Okay, so this is what is indicative of a dark cloud cover. And the moment you get to see this kind of pattern, a chart pattern, you are confirmed. So this is kind of confirming that from here on, the bearish reversal is likely to take place. Which means what? This indicates that it is the sellers who are taking over the. You have to be very careful on all these confirmation, okay, And if you get to see this kind of a pattern, it indicates a bearish reversal. Okay, so traders, they typically see if the candle following the bearish candle also shows declining prices. So a further price decline following the bearish candle, which is this, is kind of called confirmation. And after that, you are highly sure that from here on, the sellers are dominating or are likely to dominate. And then in that case, it's advisable to take a short. Okay. So you can see this dark cloud cover over here. Yes. Yeah. Where do you see this dark cloud? Anybody? You get to see this dark cloud? Yes. So here, over here, you get to see the dark cloud. White, red. Again, on the very next day, there was, so here it is. See this red line? The next day, of course, if you look at the highest price, it was very much at par with the previous day. But if you look at the lowest price of the day, if you look at the lowest price of the day as compared to the previous day's candlestick, it was much, much below that. It was much, much below that. You see the lowest price and the lowest price? So there's a huge difference. Although the highest price is one and the same. Okay, so even though the candlestick for that day is green in color, but since the prices are being pulled down phenomenally, which means the sellers have been able to make their mark in the market, the very next day it is, and of course, depending upon the kind of news which is coming in the market, you just see what is happening. The prices from there on are continuously moving. Okay, so a dark cloud cover. So just over here you see, look at the pattern, the lowest price of the day after you have witnessed the bearish sentiment in the form of a red candlestick. So you see the very next day what is happening is that the lowest price of the next trading day is much below than the previous day's lowest price. And from there on, what you get to see, a reversal trend and a bearish reversal. Okay. So a dark cloud cover is a candlestick pattern that shows a shift in momentum. So here it was on the higher side. The prices was moving up, higher highs and higher lows. Okay, and then you get to see this red candlestick. Okay. Again, you get to see a green candlestick, but the most important thing which you have to see over here is look at the lower price, the lower price. Okay, so the lowest was very, very low as compared to the previous day, which kind of confirms that a bearish reversal is likely to happen. So that shows a shift in momentum to the downside following a price rise, and the pattern is composed of a bearish candle that opens above, but then closes below the midpoint of the. You see this? It closes below the midpoint of the. You see this, it closes below the midpoint of the prior bullish candle. So this is very important for you to understand that a price reversal is going to happen after this momentum. Okay, so the pattern is composed of a bearish candle that opens above but then closes below. As you can see, it closes below the midpoint of the prior bullish candle. So both candles should be relatively large, as you can see, showing strong participation by traders and investors. So when the pattern occurs with small candles, it is typically less significant, right? But here, since it is a long real body, it kind of makes your decision more strong and you're more confirmed. So traders, they typically see if the candle following this bearish candle, okay, also shows declining prices. So yes, it shows declining prices. And a further price decline follows the bearish candle. Follows the bearish candle is kind of a. So this is a dark cloud, okay, which indicates a bearish. So again, some more examples of dark cloud cover. You see this. white candlestick and followed by a black candlestick, followed by another black candlestick, which is kind of confirming the bearish sentiment. Okay, and the next two trading sessions, just see the highest price, the lower price, the closing price, and the opening price, and not much of a significant changes to be seen. And from there on, you get to see the prices have come down. So essentially, you get to see these three candles, which kind of confirms that from there on, most likely in the near future, the prices are going to come. Again, a dark cloud, as you can see. Just see, this is more prominent. So at times you will be getting very prominent signals in the form of candlestick. At times you have to wait maybe for one or two trading sessions to actually understand which direction the market is. Okay, so here this is very clear that from here on, after you have seen this black candlestick, okay, again there is another black candlestick or a red candlestick. Okay, right? And then from there on, to see how the prices are. And this dark cloud is usually seen in a momentum phase. So in a momentum phase, once when the prices are up higher highs and higher lows, and then you get to see this kind of a bearish candlestick followed by another bearish candlestick. It kind of confirms that a bearish reversal is most likely to. Okay, so this was about the dark cloud cover, and if it is what you witness, you understand that it indicates a bearish reversal, and that is the time when you have to take a short position. Okay. So yes, so we end over here. And so we have taken up several chart types, which kind of makes us understand that what is going to be our kind of trading in the very next day after the confirmation of a particular trend. So the moment that trend is confirmed by a candlestick, which is happening immediately after a hammer or a hanging man or a shooting star or a dark cloud cover, after that we have to look at the immediate candlestick after that, which kind of confirms as to which direction the prices will be. And if it confirms that kind of a pattern, then of course we will be taking a position accordingly. Right? So if the market is going up, then we will be taking, which means a kind of a bullish reversal. Then it's better to go for a long position, okay, and exit the short positions. And if it is witnessed that it is going to come down, then it's better to exit the long position and start taking the short position. However, be very sure about that candlestick, which kind of confirms as to what is going to. But please refrain yourself from from entering the market if it's very choppy, because then you don't get a very clear cut kind of an indication as to which direction the market will be. So these kind of chart types you can actually pay more importance and more impetus to this kind of a chart types only and only if you get to see a confirmation with respect to that. Okay, and otherwise, if it is not very clear, if it is not very indicative, then it's better to sort of refrain yourself and not enter the market first. So with this, we come to an end to our today's technical analysis session 4. In the next session, we are definitely going to look at some other chart patterns, and then we will be moving to the charts as to how to read the charts. And over there, all these chart types which we are studying will be giving you a lot of inputs as to what should be your position in that kind of a. Thank you so much.